Welcome to Markets Now. We had a higher close in just about everything except for the cattle complex today. And joining us to visit about that is John Payne with HedgePoint Global Markets. John, let's talk about the grain complex first. So soybeans, kind of the price leader, pulling corn and wheat futures back to plus side status. And some of that had to do with some China news about COVID. Talk about that.
Yeah. So as a lot of us, if you've known me for the last 2 years, I've been saying, hey, we need to be ready for the Chinese to reopen their economies and start to see the world moving around again, kind of like it did in 2019. But up till this point, we haven't really seen any type of action taken. That continues to be the case today, as we're seeing lockdowns across a lot of big cities in China. But there was a mention, was it early in the morning on Tuesday, that a committee could be formed to talk about the exit of zero COVID policies in China. And on that news, we saw a nice surge in beans, but really a big move in cotton as well. Cotton has been maybe the doormat of the commodity complex. Coffee I could probably throw in there as well, but cotton specifically, Michelle, we talked 4 months ago, we're trading at record highs, and now we're trading essentially below where we were when COVID started. So there's a lot of moving parts, I think, to cotton in the short run here. But China reopening is one of the big keys to getting the merchandise trade moving again, as well as a lot of other factors when it comes to inflation. But I think this is the main one.
So cotton looked very undervalued. I mean, we hit, 22-month lows here this last week with our weekly close. And so do you think that market got too cheap, and how much of a rebound do you think we should see here?
Well, let's break it down into the old crop. So you got the old crop supplies, which is, we see a huge carry come out of the market. March, July of this calendar year coming, they were trading 15, 20 cents above the new crop December 23. And now we've seen those almost narrow to par. Going out into the curve, December 23 traded down to 70 cents just 2 days ago. December 24 traded into the 60s. So I think you start to look at what is needed for price to incentivize producers in the United States to plant cotton on the margins. I mean, you're looking at 10 cents up. I would think 80 cents needs to be done with $6 corn. It's a guess. And I think at this point in time, that market, tread lightly if you're in it. They can do a lot of things that don't make sense. And in the case of cotton, I think you're dealing with the Chinese currency. I think that's the main driving factor right now. And their decisions are made on a whim, and sometimes they're made without us knowing about it. So we closed limit up on Tuesday, which I think is a harbinger for better trade ahead. But we'll see what the USDA says next week in regards to demand, because we export so much demand, it's easier to carve into that, unlike it is, say, for corn or soybeans, where we have a big domestic base. So we'll see what the USDA says on Wednesday of next week.
Yeah, and demand and recessionary fears have certainly been overriding this low production number that we have historically. Just from a production standpoint, though, it feels like cotton is undervalued at this point. Do you think that?
I think so. I think what we need to see is inventory chewed through first. You look at the Nike earnings from a couple of weeks ago, Levi's, which are the big producers. There really isn't a big clothing producer, merchandiser in this globe right now who's making any money. Or if they're making money, they're seeing inventories build. So you've seen companies like the Gap go up, darn near out of business now. And I think at some point here you will see a similar type of capitulation event. And then the next thing is we'll see contracts need to be resettled again. And hopefully, I think from the producer side, it comes after the crop insurance periods are set. I know a lot of old crop folks are saying, hey, we don't really care what the old crop market does because it's insured essentially right now up at $1. So from the U.S. producer standpoint, they should be chock full of cash relative to what they would be getting now. But as far as planning decisions for next year, it's hard to see somebody sticking out there. The cost of a picker in Texas is just massive, and the investment is massive. I would think they're going to stick to something cheaper like Milo, or maybe even go into something like soybeans if it's possible.
Okay. And since you mentioned soybeans, let's circle back around on that. Soybeans had a very strong technical close on Monday, and we kind of added to that now. Do you think we're going to get more technical buying in that market as a result of that, or is there more of a fundamental push here right now?
Well, I think the technicals could certainly change. I think the near-term factors you want to watch are the meal specifically. I think if meal could really get going, I think that breaks some shorts out here, pushes the complex even higher. If meal would fail, when we've had a hard time getting over that 420 area on the front month contract, I think then you see, beans kind of consolidate with a little more of a technical sideways trade. But I won't be the first analyst on here to say it's about South American production. At this point in time, all things look good, but we're entering that period where you and I will discuss, potential haircuts on yield and things that can happen with, supply that's going to be needed. And again, as I mentioned to start it, China matters. They have very little meal on hand, and they have really a lack of soybean supply. So they're going to have to import, even if they're chock full of Brazilian beans. I think the U.S. should still see it. Throw on the fact that we have $4 crush margins here, and there's going to be some competition for the supply.
So corn and wheat followed soybeans to some degree, but we had a little bit of new news to push those markets as well.
Yeah, I think a lot of us in the trade saw the trade news over on, was it Saturday, that the grain corridor was going to be abandoned, and we were preparing for fireworks on Sunday night, and really we got one firework and it just fizzled out. So we settled out here kind of where we opened on Sunday night. I think the news out of Argentina in regards to wheat matter. And then I think you have a short trade that's in the Chicago wheat. So a lot of speculators are parked short. I think you could see some explosive moves in both that and the European Matif contract here if things develop in Russia like we expect. So that pulls corn, and we're still dealing with low exports in this part of the world. So if things would ever change on that front, I think we head up into that gap near 750, which seems likely at this point.
Plus, winter wheat had one of the lowest crop ratings for this time of year ever, so I'm sure that should be something to be somewhat respected. So let's end on the cattle market. So we've been consolidating after the contract highs here. Some of this is just kind of fear about what the Fed's going to talk about here on Wednesday, isn't it?
I think a little bit, but I really do think you watch the choice prices. We've seen beef rally close to $30 on the boxes over the last 2 to 3 weeks. Putting us up here in the 260s. The folks that I work with, I think we're expecting cash to soften a little bit here. So maybe once we get past the kind of pre-buying ahead of Christmas, and that does bring, I think, markets down to a little bit of a lesser degree. But I think in the long run, you've got some major fireworks on hand. We are now through the point in the cattle on feed numbers, so to speak, that will come out. We'll start to see year-over-year deficits rather than year-over-year surpluses in the yards. And I think at some point here, the feedlots are going to get squeezed. That's my kind of take. It's their turn. It's been the cow-calf guy for the last really 3 years, 4 years. And I think now it'll move into the feedlots because I don't think the packers are going to give up much.
Yeah, that marketing hole is coming, that's for sure. Thanks so much for joining us, John Payne with HedgePoint Global Markets. And that's your markets now.